See, to calculate your IRR, you should follow the instructions instructions of computing the NPV. Okay, till NPV everything should be taken, and then last at final, after getting an NPV, you just, what you have to do, you have to click on IRR, you have to click on compute IRR, finished, or IRR compute, you will get the answer. So take your calculator, and yesterday you have closed it till here, right? Again follow this function, you get this NPV fast. I'm asking right now to do, to get, you get this NPV on your calculators fast. And report me after calculating. Is everyone following and listening to me? Hearing me?
Yes, sir.
Yeah.
Yes.
Yeah. Did you get this?
Yes, sir.
Now, after getting this, come to this instruction and just you click on IRR compute. Are you getting this 19.4377? Tell me. Yesterday I have discussed about this. I'll move forward.
Yes, sir.
Finished. If you have clicked on IRR compute, if you've got this, that is the final thing. Okay. Let's move forward and come from the beginning, where we have missed anything or where we have to cover up. Okay, so now here comes the capital allocation process. I think we have discussed about this. Okay, yeah. So capital allocation process is identifying and evaluating capital projects, of course. That means you are going to allocate your money or capital for that particular project. When you are supposed to or going to allocate your capital for a particular project, of course what makes sense is you're going to identify which is the best project for you, and also you are going to evaluate those projects. Okay, and yesterday we have seen two of the methods with the help of which you're going to do that. So any corporate decisions with an impact on future earnings can be examined using this framework. Of course, you are taking a big decision to invest your money into a project. So that is a corporate decision, and your decisions can have an impact on your future earnings. And then you have to examine the projects what you are going to pick up and allocate your capital. So definitely you are going to follow the framework. Which framework? The process what you need to follow to like invest your money. Now, decisions about buying a new machine or expanding business into another geographical location or area, moving the corporate headquarters to Cleveland, that is what a state in US, or replacing a delivery truck, to name a few, can be examined using a capital allocation analysis. So for all these purposes, you require a huge amount of money or capital, and then you have to do the analysis, because you are going to allocate your capital for all these activities. Now, for a number of good reasons, capital allocation may be the most important responsibility that a financial manager has. Of course, when you're hired as a manager in the future, you may have this very big responsibility of of going for a capital allocation process. Now, first, because a capital allocation decision often involves the purchase of costly long-term assets with lives of many years, the decisions made may determine the future success of the firm. Second, yes, so you are going to put your money, right? So you have to buy very costly long-term assets, and that asset should have a very uh, like lot many number of years it should have a life. Okay, so it should have an extended period life, and this all kind of decisions then can have can make your firm successful in the future. Second, the principles underlying the capital allocation process also apply to other corporate decisions such as working capital management. Once you finally decide that one project you're going to take up and you're going to put your money into that project, then it's not only putting the capital in the project is what is the final task which you are going to perform with respect to putting money into a business. Again, you have to ensure that all the working capital requirements are to be fulfilled. Hence comes the working capital management and making strategic mergers and acquisitions. Of course, that can also happen during the later period of time in your company after you become 10 or 20 years old company. Finally, making good capital allocation decisions is consistent with management's primary goal of maximizing shareholder value. See, why are you taking proper or good capital allocation decision? Because the directors of the company have made promises to their shareholders that they'll maximize their wealth. Hence, it is always important for them to pick up profit making projects. Now, the capital allocation process has four administrative steps. Administrative in the sense the management of the company is going to take these four steps under the capital allocation process. First, idea generation. The idea should come what kind of project you are going to take up. Okay, and the ideas can come from number of sources including senior management, functional divisions, employees, or sources outside the company. Then you will study the project thoroughly. You'll do the post-mortem of that. I can say that means you're going to do uh, everything in and out like research for that project, because you want to you are supposed to take a decision regarding accepting or rejecting that particular project. Okay, and then you have to see that that project is going to give you expected profits. Then create the firm wide capital budget. Firms must prioritize profitable projects according to timing of projects cash flows, available company resources, and the company's overall strategic plan. So they have to prioritize the projects which are going to be very profitable for them. They should not lose that chance, and also they should see what resources they have and what they have to arrange for that. Many projects that are attractive individually may not make sense strategically. Monitoring decisions and conducting a post audit. Then whatever the decision you have taken regarding the investment in the project, you will invest, and then you have to conduct audits so that all the shareholders may understand that each and every penny what we are showing under the book in the books of accounts really has been spent, and all the audit, whatever the audits are done based upon proofs and evidences. The auditors would cross check everything in the company. Wherever they have an element of doubt, they may even cross question, and they may try to figure out the root cause of any frauds. They may do investigation also when required, when there are frauds happening in the company. So everything whatever is existing or shown in the books is existing in reality or not is what is the auditor going to do and check. And then sometimes errors may happen because we can't rule out human beings not making errors. Yeah, human beings can sometimes do certain erroneous acts. So those will be, of course, those would be of course traced out. If at all there is a fraud, then that also would be coming out of the coming out because of the process of audit. Now, NPV is done in yesterday's session. IRR is done in yesterday's session. Yeah, one point I would like to explain you. So yesterday we discussed that IRR is nothing but the cost of capital at which the NPV is zero. Fine. Now there is a NPV rule and IRR rule. I'll write it separately here. Only positive NPV making projects should be accepted. Negative NPV projects should be rejected. Point number 2, like when it comes to IRR, the minimum IRR above which a project will be accepted is often referred to as hurdle rate. Projects with IRRs above this rate will be accepted, while those with IRRs below this rate will not be accepted. So what are they saying? So there's an example here. Continuing with the cash flows presented in 26.1 figure for the previous example, calculate the IRR of the project and determine whether it should be accepted or rejected. Assume the required rate of return is 9%, right? So now your hurdle rate is 9%, correct? That is what the required rate of return what you have. So IRR above which a project will be accepted is often referred to as hurdle rate. Projects with IRRs above this rate will be accepted. So now here we had 19.3, 19.4377%. Now please all of you tell me yes or no. This is what is your IRR and this is your hurdle rate. Your IRR is more than your hurdle rate, right? Correct? IRR is more than hurdle rate. Will you accept or reject this project? Come on, tell me.
Accept.
Why?
Because the hurdle rate is less than IRR.
But what? But why?
So because 9% is the minimum amount of required return that we get, and 19 we are getting 19% of
So
returns
why
where
don't you want higher returns?
yes, sir.
Then see, you should understand one thing. At 19.4377, your NPV was how much?
Yeah.
At 9%, your NPV will be positive or negative?
Positive.
Of course, because this is a lower discount rate. If the discount rate is lower than IRR, that means this at this rate the discounting would be happening less. Less cash would be discounted. Less future cash flow will be discounted. Henceforth, this will give you positive NPV, and then we can accept the project. And if the IRR is less than the hurdle rate, let's say your hurdle rate is 25%, let's say, and your IRR is less than your hurdle rate, okay, you reject the project. Why? Because your IRR will give you 0 NPV, but 25% can give you negative NPV, okay, because more discounting. So you reject the project. So IRR more than hurdle rate, accept, because here your hurdle rate can give you positive NPV because IRR is giving 0. Here your hurdle rate will give you negative NPV because IRR will give 0. Okay, so reject the project. You should understand in this way. Okay. IRR below this rate will not be accepted. Just a second. Next one. Now there is some problem with IRR. I hope everyone understood this one. Please tell me yes or no. Pawan and Isha, did you understand this concept, please? I'm asking to all of you, did you understand this concept? Yes or no?
Yes, sir.
Yeah, you understood, Bhargav. What about Pawan and Isha?
Yeah. Yes, sir.
You understood? You're sounding not sounding that confident. I think this was covered in ACC as well. Pawan, what is your answer? Where are you? Okay, give me a second. Give me a second. Just a second. Okay. Now the next question. The problem with IRR is IRR will not give you proper, like you cannot trust IRR. You cannot really trust the IRR because it is not a superior method. Okay, it is not a superior method. So why it is not a superior method? There is a reason for that. The reason is when a particular project has unconventional cash flow pattern, there can be a chance of multiple IRRs. So let's say this is the projects. I'll just draw a diagram here. So this is the this is the cost of capital at which your NPV is exactly equal to 0. This is your NPV. Okay, you may have some positive NPVs here. Here you may have 0 NPV and here you may have negative NPVs. Let's say there's 7% and there's 35%. Conventional, this is the graph I'm making. Conventional cash flow pattern. When there is a conventional cash flow pattern, there is no problem for having multiple IRRs. What is multiple IRRs is a project having two IRRs. Just give me a second. Just give me a second. Uh, can you hear my voice right now?
Yes, sir.
Before this, you were not able to hear for some seconds. Okay, okay.
It was all.
Yeah, now I have unmuted the mic. Yeah. I think by mistake it went on to mute. Okay, now you can hear, right? Okay. Yeah. So I was saying the problem with IRR, see, IRR is not a trustworthy method, I said, and it is not a superior method as well. NPV is a very superior method. Now, if I tell you this statement, I also should have to justify you why this IRR is not a superior method and why this NPV is lot more superior method. Why IRR is not a superior method is because of the like unconventional cash flow pattern. This is conventional cash flow pattern. This side there can be unconventional cash flow pattern. Now you may have a question in your mind, what is this conventional cash flow, what is this unconventional cash flow? Let's say the investment in the project is $100,000 and the first year the cash flow is 10,000. Second year cash flow is minus 5,000. Just a second.
Yes, sir. Vasan, sir.
Okay. Okay. So I was saying what is unconventional cash flow pattern. Here you have 10,000. Here you have negative 5,000. Then you have 20,000. Then you have negative 10,000. Then you have 30,000. This is unconventional cash flow pattern because sometimes you have positive cash flow, sometimes you have negative, then positive, then negative. What is conventional cash flow pattern? Which is nothing but which is very much expected one. Many a times 10,000, 20,000, 30,000, 40,000, 50,000. So when you have such kind of unconventional cash flow pattern, and if you want to find out your IRR, you may have multiple IRRs. Let's say this is the diagram I'm drawing. That means for this kind of project, you may have IRR at 7%. This is NPV, right? This can be any value, 1 lakh, 2 lakh, 3 lakh, 4 lakh, negative 10,000, 20,000, anything. The cost of capital, which is 7%, at which your NPV is 0, is your IRR. So here you got one IRR, and also at 35% you got one IRR, and this is because of this unconventional cash flow pattern. Now, when subject to this particular project, how will you decide whether to take this project or not? Because it is giving you two different returns. How is that possible? In case of NPV, if you get positive or negative, that's more than enough for you to pick the project. That is the concept. What they are theoretically saying, I have explained you practically. Okay, now so they are saying that spreadsheet software is most suitable for calculating NPV and IRR with unconventional cash flows. You don't have that spreadsheet and all. Just it's a casually they are sharing some information and trying to enlighten you that if you want to calculate your NPV or IRR with unconventional cash flows, you have to take the help of softwares. Now, relative advantages and disadvantages of NPV and IRR method. Now, we haven't come across the advantages and disadvantages of both the methods. And let me be very frank and clearly, I am saying you, the superior method is only NPV. Okay, that we will be understanding with the help of this particular theoretical concept. Now, a key advantage of NPV is that it is direct measure of expected increase in the value of firm. Of course, if you are investing 100,000 and you are getting a positive NPV, then your project is a worthy project, and then that project can add value to your firm, right? In theory, a positive NPV project should cause a proportionate increase in the company's stock price, of course. Key advantage of IRR is that it measures profitability as a percentage. Yeah, for a layman, if I speak about some doctor, some scientist, some one who is not associated with the field of finance, for them, they won't understand what is this positive NPV or negative NPV. It's Greek and Latin for them, of course. That means now you have to take them into this world and try to explain you why in the world, why someone would take that kind of pain and understand all this when they are getting some direct answers which easily goes into their head, that is in percentage form. So IRR tells you that this much percentage, this much is the percentage at which your projects, whatever you have invested, you'll get back. So that makes sense, right? So it is in percentage form and it is very easy to understand. And the IRR provides information on the margin of safety that NPV does not. Yes, now it shows you that at this percentage you are able to get whatever you have invested. So then you can easily understand like this is the one at which you are able to break even kind of, but that you won't get from NPV. From the IRR, we can tell how much below the IRR the actual project return could fall in percentage terms before the project becomes uneconomic, has a negative NPV. Of course, we have discussed that before. We were comparing the IRR with the hurdle rate, and we saw that if the IRR is more than hurdle rate, it is good, and if IRR is less than the hurdle rate, it is bad. Okay. With this, we easily understood that let's say the hurdle rate was 9% and your IRR was 19.377%. So from the IRR, we can tell how much below the IRR. So below the IRR is like, below the IRR estimated the actual project could fall. See, if at all it is acceptable for you to take a project, if it is like, anything less than this, right? This kind of idea you are getting with the help of IRR, right? With NPV, you will not be able to get that idea. Let's say your IRR is 9% and your projects and the hurdle rate is 15%. That means what? At this you are getting 0, at this you will get negative NPV. So how much the return should fall for you to get a positive NPV, that you can understand with the help of this particular concept, because now your IRR is 9%. At this your NPV will be 0. At this your NPV will be negative, right? Here your NPV is 0 and here your NPV is negative. So now how much the returns, how much it should fall from this percentage, so that you can get at least 0 NPV or positive NPV, that you can calculate 15 minus 9 by 15. That can tell you how much it should fall. Okay. Now, disadvantages of IRR, of course, is there. It assumes that projects' cash flows are reinvested at IRR, while NPV assumes that those cash flows are reinvested at projects' required rate of return. It is more realistic to assume the latter. That means, if at all you are getting from IRR you are understanding that the project is a worthy project, then you may have some extra cash flows. Let's say that cash flow you have to reinvest at IRR only. That is what is the assumption of this method. See, every method runs with an assumption. It is not something what like looks to us right or looks to us wrong. There are many blunders in this, but still there are certain assumptions or premise based upon which these methods run. But in real world, we always will not be reinvesting the project's excess cash flows at the same IRR. That means at this particular rate of IRR will not be always reinvesting. If at all we may get good returns, we may go for that particular, we may be investing at that rate. And in NPV, in case of NPV method, they say that the excess cash flows what you get out of a project, since if you're getting a positive NPV, you would be reinvesting that at the project's required rate of return, and it looks more realistic because that is what you require. Now, already discussed, for multiple sign changes, a project may have multiple IRRs that are difficult to interpret. Fine, finished. Now, return on invested capital. What is your invested capital? The money which you are investing into the business. So, what is the formula for ROIC? You will be taking your net operating profit after tax, because operating profit is what is more relevant to you in this case, and average book value of total capital. That means $1 invested is giving me how many cents of operating income. So let's say if my total, if my average book value of total capital, average book value is only possible when you have opening balance of capital and closing balance of capital. That means you're going to calculate this at the end of the year, and then you have the average. So let's say $10 is your average, and net operating profit after tax. That means you got the PBIT. This is profit before interest and tax. Okay, this is called operating profit. Operating profit. Okay, but you have to remove the tax, and then you get operating profit after tax. Let's say that is $1. So on $1 investment, you've got 10 cents. That is the interpretation. Fine. If it is more than the previous year, that is always appreciated. Now, just a second. Yeah. So let's see, one way to examine whether a company is creating value for its shareholders is to compare the return on company's investment in assets to its cost of capital. That means what returns you got 10 cents from investment of $1. That means you got 10% returns, right? You got 10% return on assets, return company's investment in assets to cost of capital. So if the cost of capital or required rate of return is 8% and you got this much, it is good, right? Now, so yeah, and after tax operating profit is net income plus after tax interest expense. Yeah, after tax operating profit. So I have PBT. Okay, profit before tax. Net income, I am removing the taxes, I am getting PAT. This is my net income. Okay, so after tax operating profit is net income plus after tax interest expense. Okay, so if this is my net income PAT, I am adding interest to this, but this interest I am taking after deducting the taxes. Let's say my PAT is 10,000. My interest expense is 1,000. That is before tax. So I'll be removing tax from this. 1 minus 0.30. Tax is removed. So 10,000 plus 700. So 10,700 is my net operating profit after tax. Okay. Please tell me yes or no. Did you understand this? Hello.
Yes, sir.
Are you following, by the way? Yeah. After tax operating profit is nothing but net income. I already explained you net income is you have removed taxes from PBT. So you get PAT. That is your net income. Net income plus after tax interest expense. So I took interest expense and I removed taxes. So I got this. So this is nothing but NOPAT, net profit, net operating profit after tax. Now, because companies can claim deduction on tax, on interest expense, right? So yeah, so now they are giving good valid reason to you to understand why all this we are doing. We use this because we want to measure the return to all sources of capital. See, a company is not only run with equity. A company is at times run with debt as well, and at times a company is also run with debt and equity. So why are we taking operating profit? Because the profits are reward for equity holders and interest are reward for the debt holders. That's the reason why operating income is considered. Now the denominator is the sum of average book values of debt and equity. That is what the average invested capital means. Opening balance of equity plus opening balance of debt, okay, or the combined total of debt and equity opening balance plus the closing balance of combined total of debt and equity divided by 2 can give you average invested capital. And this ratio can also be broken down into this particular two parts, as we have studied that in the ratios chapter, whereby we had DuPont analysis. We are seeing by making a sale of $1, how much operating income we are generating, and the sales what we are generating here is after the investment of certain capital. That means if I have capital, I will invest this money and buy certain assets for my company like plant, machinery, land, building, etc. I will be using those assets and I will be generating revenue. Okay. Okay. That is what here it is. Sales by average invested capital. And then from this sales, I want to know what is my operating profit. This is cancelled. Then I get ROIC. Next. We refer to the ratio of after tax operating profit to sales as operating margin after tax. Very important. And we refer to the ratio of, so this is operating margin after tax because it is NOPAT. So this is operating margin after tax. Okay. And whenever you divide operating profit with sales, you get operating profit margin, operating profit after tax margin into capital turnover ratio. With $1 invested as capital, how much turnover you are generating. Okay. Okay. Or with $1 investment in the business, how much revenue you are generating. So like this is the formula: capital turnover or asset turnover. So capital, because the capital what we raise in the business or in the company, we are generally going to use that money for buying the assets for the company, and the assets what we are buying is only for the sole purpose of generating revenue. So capital turnover or asset turnover. So operating profit after tax margin into asset turnover or capital turnover is nothing but ROIC. Give me a second, sorry. Okay. Now, so analysts compare ROIC to investors' required rate of return. In this context, the required rate of return is blended rate for both debt and equity. If ROIC is greater than the required rate, the firm is adding value over time. Yes, that means that's what we were discussing here. Sorry. Yeah, we were discussing here something. Yeah, they are saying whatever you require, let's say you require 10% returns and your ROIC is like 12%. So your 12% is more than the 10%, right? So this is a good performance or not? Come on, tell me. Hello? Hello?
Yes, sir.
If your ROIC is more than the required rate of return, it is good or bad? It's good.
It is
Why?
good,
Because
sir.
the firm is adding 2% extra value. Is it right? Or the project, whatever you have taken up, the firm is adding value over time. That means what you expected, it is giving you more than that with the usage of the assets, more efficient utilization of assets and generating turnover with those assets and even generating and even whatever the turnover you have got, with that you're getting good amount of profits as well. So that combined, that particular thing shows that you expected 10, they're giving you 12. That means extra 2%, it has added value to your firm, correct, company. Now one more thing, I think we discussed the same thing before that also. I was giving you the idea here. 10% is what you got, 8% is what you expected. More than that, if you get, it is always good. One attraction of ROIC is that it is based on accounting data. Now comes the thing. See, first of all, accounting data is something which can be manipulated. First and foremost thing. There are issues with NPV and IRR methods also, we have discussed. All this NPV and IRR, what we are calculating is not after getting the cash flows. These are all pre-estimations. We are finding out the NPV of a project beforehand. We are finding out the IRR of the project beforehand. And all this we are doing before investing our money. That means all these are estimations. Your required rate of return is an estimation. That means something which you want, you have estimated and you have set that or expecting that return to materialize in the future. The future cash flows, what you are taking to calculate your NPV is also your estimation or your expectation. Fine. So all these points are there. So since there are also some disadvantages we have here, also we have certain disadvantages. The disadvantage is ROIC is based on accounting data and accounting data can be manipulated. That I am giving you extra information which are available to outside investors. While NPV, this is like, one of the best things which is something, very handy for the investors, because this particular ROIC you are calculating based upon the accounting data, which is easily available to all the investors who have invested in the company. But NPV and IRR are something which are internal to the company, which are project specific. Okay, this details the company won't share with investors. This is what they are using for decision making purpose. So ROIC is for the firm as a whole. So ROIC is more relevant for outside investors because they typically cannot invest in a firm's individual projects. If they get some idea or some confidence, then only they are going to invest. So this can give them good confidence. There are three concerns with using ROIC. Because accounting treatments differ, ROIC may be comparable across companies, may not be comparable across companies. For example, company A and company B. Company A is using FIFO method for valuing their inventory or straight line method for depreciating their assets. Company B is using weighted average method, that is AFCO, for valuing their inventory, and they are using diminishing balance method for depreciating their asset. It is not easy for these two to get compared because they are using different, they are giving different accounting treatments. So it is not that comparable. These two businesses are not exactly comparable at times. Then ROIC is backward looking and can be volatile from year to year. Of course, this is not stable. This can change because ROIC is for the whole company. That is from the investor's perspective and from the company's management perspective. It's for the whole company. It may let profitable projects and good decisions mask unprofitable projects and poor decisions. So what happens, this is for the whole company, right? It may let profitable projects only and good decisions mask unprofitable projects and poor decisions. So based upon this, if you are taking good decisions, definitely at times you can kind of mask the unprofitable. That means those can be hidden because of good returns what you are seeing here. Okay. So here what they are saying is the weightage of good decision is more than the poor decision. The weightage is on good decision side, because this based upon ROIC you are taking certain decisions of further investments. Okay, so this topic is done, and there are certain more points to be discussed that we will be discussing right now. What is that? Let's see. Capital allocation principles and real options. Describe principles of capital allocation and common capital allocation pitfalls. Principles of capital allocation. The capital allocation process involves the following key principles. Decisions are based on after-tax cash flows, not accounting income. Of course, whatever the capital allocation process is happening, or you are taking a decision to invest your money based upon the capital budgeting or capital allocation process or principles, you only consider after-tax cash flows and never you consider accounting income. Okay, so that is what you should be first understanding. And firm value is based on cash flows. Firms get to keep, not those they send to government. Any tax savings can happen when you claim deductions from non-cash deductions such as depreciation and amortization should also be included in the analysis. That means any kind of deduction, tax deduction or cash savings from tax deductions, here you are using depreciation expenditure as a tax deduction tool. You are reducing your tax liability because of this particular expenditure called depreciation, which is allowed as a deduction. So let's say if you had 100,000 taxable income and there is no depreciation, let's say you cannot claim depreciation as an expense, you cannot consider depreciation as a a tax allowable deduction. Let's say if you cannot use depreciation as a tax allowable depreciation, then what can happen? You have to pay 30% tax on this. That is 30,000. Let's say if depreciation is considered as a tax allowable depreciation, so let's say 20,000 is your depreciation expenditure. I'm removing that from this. I'm getting 80,000. On 80,000, if I take 30%, I am paying a tax of 24,000. And I'm saving 6,000 here. So that is what is a very important cash inflow for me, this cash savings. So I consider this in my capital budgeting or capital allocation decision. Incremental cash flows only. Of course, what is relevant for the business is incremental cash flow. Only incremental cash flows you should be considering. What is incremental cash flow? Because if let's say you are taking up a project, because of that, if there is some increment in expenses, because taking the project, you are expecting more revenues to be generated. So increment in revenues, increment in expenses are incremental cash flows have to be considered. These are relevant for your decision making. Fine. And very important. Let's say if you come to my academy and I like the fees I'm charging to you is 10,000 rupees. And you have paid the fees. I have directly given you a fee receipt, and after that I tell you have to deposit 3,000 rupees with us as a safety measure for books and other services, and then this particular 3,000 is increasing your fee structure to 13,000 or not as of now. Please tell me yes or no.
Yes, sir.
Will this extra 3,000 impact your decision to take admission in my academy? Of course, because you will clearly say this 3,000 is what you're charging is not relevant, is something which is extraordinary, which no one is charging, and we don't want to take admission at your place and you want to drop. So this particular thing is relevant for the decision making. Yes, this is very relevant for decision making, because this 3,000 will be the deciding factor of you joining in my academy. See, there are many people who can provide you good classes. It's not like someone, only one person, but still there are many people who can give you guidance and all. This is something very much extraordinary hidden charge and not justifiable as well. Okay, so this is incremental cash flow. And sunk costs are irrelevant for your business. That means depreciation. There are certain expenses whereby you don't have any kind of control over them. Those are useless, irrelevant. That means even though you perform certain activity or you don't perform certain activity, these expenses you have to incur, like depreciation, like research expenditure. That is one of the, these are two sunk costs. So sunk cost, depreciation, research expense. Okay, now then you have to consider certain more things, that a negative effect called cannibalization. Cannibalization is nothing but, there was a movie by this particular name called Cannibal. In that, a person used to, there were some friends who went for an adventure trip, and in that one of the friends, there were some group of friends, and one of the friends, he was man eater. Actually, he was a cannibal. Cannibals are someone who eat men. So he started eating all his friends one by one they died. Sorry, it's a scary movie. At the end, everyone is like, no one is surviving. Only the person who is the man eater is surviving. Now what he does, he starts eating his hands, his legs, and his body. So what he does, because he can't survive without eating all this. So it's like a person eating his own arm is nothing but creating, it's like a very big loss for that person, right? Because one of the parts of the body is not present now. He wants to eat it. So now the same thing comes. An example of cannibalization is when a soft drink company introduces a diet version of an existing beverage. So Coca-Cola. So Coke is a company and they were selling the soft drinks. It was doing very well, but they came out with one more version, that is Diet Coke. And this was more, health. This was more, healthy. I won't say soft drinks are healthy, but in fact, very less impacting one. If you think that these are not good for health, this is somewhat more health conscious kind of thing. Okay. So now this, when after launching this, they started losing the Coca-Cola's business. This is cannibalization. So don't do such things whereby one product of yours can kind of impact the other product sales. So a positive externality exists when doing the project would have a positive effect on sales of a firm's other product line. That means if they would have launched something which would have, enhanced the Coca-Cola sales, that would have been great or good. Not this. That means they would have come out with some juice or some kind of tumbler like serving version, whereby adding this Coca-Cola only, like let's say they make soda. Coca-Cola has come out with some soda, let's say, and this soda is utilized for all the drinks like mojito or any kind of drink. So that is, the soda business will be very much increasing if these kind of drinks are using this particular raw material, which belongs to the same company. Okay. Timing of cash flows is very important, and that is usually at the end of the year. And common mistakes manager make when evaluating capital projects have two categories: cognitive errors and behavioral biases. Cognitive errors is calculation errors and behavioral biases is errors of judgment. See, calculation errors can happen because everything you are estimating, you are forecasting, you are not considering the cost of internal funds. Okay, what is that they are saying? Examples include incorrectly allocating overhead costs or neglecting to anticipate how competitors will respond to a project. What does it mean? Just a second. How much more is left over? We have certain good amount of topic only. Fine, we will take some more 5 minutes. Try to explain this, because this is like something going. This over allocating overhead cost and all are some concepts which you have to learn. Not just reading is something which will give you the idea. So poor forecasting examples include incorrectly allocating overhead costs. See, allocation I have already explained you. So there is certain overhead a company is incurring, and they have to allocate this to some specific department or some specific segment or some specific activity. So sometimes this overhead belongs to a activity which is activity 1. Okay, and it is purely a overhead related to this activity. They are allocating this to activity 2 by mistake, and then such kind of blunders can happen. That means allocation of overhead, like some salary, let's say activity 1, I'll say this is production department and this is sales department. There is a so they have the expenditure like overheads here. There are two types of overheads they have. They have to pay salaries to sales manager. They have to pay salaries to production manager. So what they do, they show the sales manager's salary in the production department expense, and they show that is wrong allocation. They show the production department salary in the sales department like expenditure. So this is wrong allocation, and that may give you wrong answers. Not considering the cost of internal funds. See, often the cost of, see what happens internal funds, suppose company has retained earnings, they have retained lot of money, and if they are not investing it, they are definitely losing the potential income. So if they don't consider that cost, again that's a blunder. And then incorrectly accounting for inflation. Firms can analyze projects either in nominal or real terms. Okay, so there also is a difference. See, if the projects are for short span of time, let's say 1 year, then real rate makes sense. If the project is for long term, nominal rate makes sense. Nominal rate is the rate which incorporates inflation, because nominal rate is real rate plus inflation. Okay, that means if 7% is the nominal rate is nothing but the expected return what you have or what you want from a project, and the expected return what you have calculated is after considering the inflation factor. So real rate is 5% and you have added 2% of inflation factor, because you know that the project is for long term and inflation can have an impact on your earnings. So for that purpose, since this is the risk what you have, you want to get compensated for that additional risk of inflation which can impact your earnings in this particular project. So you want 2% extra returns for that case. So then comes the nominal return, right? So incorrectly accounting for inflation. So firms can analyze projects either in nominal or real terms. There's no problem, but where they should use real rate and where they should use nominal rate is what they should properly know. If it's a long-term project, nominal rate. If it's a short-term project or government project, or if you're investing in some government securities, real rate. Okay. And see, based upon that only they are going to fix their discount factors. If I'm using 5%, which is the real rate of return, as a discount factor for long-term projects, it's a blunder. If I'm using 7%, that's good. If I'm using 7% for short-term projects, whereby inflation is also a part of my cost of, see, this nominal rate I'm using as a cost of capital or discount factor. This real rate I'm using as a cost of capital or discount factor. So real rates only for short-term projects, nominal rate only for long-term projects. But if I use nominal rate for short-term and real rate for long-term, it's a blunder. Okay. See, what we'll do is we'll stop here. We will start from behavioral biases tomorrow. See, this is a very big chapter in curriculum review. So don't think that we are going very slow with the syllabus. We can't rush like that because the concepts are to be properly understood. Otherwise, you will find a lot of difficulty in solving questions. Tomorrow is the end of this chapter, and immediately after finishing this, I am going to start capital structure. Okay. This is, you know, one reading, only one class chapter. So I think today is Wednesday, right? What is the day today?
Thursday, sir.
Thursday, sir.
Thursday. So Friday and Saturday, your corporate issuers is done. Okay, finished. That means tomorrow I'll take a 20 minutes, 15-minute session for the leftover thing. Then what I'll do is I'll see if I have some like half time, I'll try to finish business models. Tomorrow these two topics will be done. Saturday we can take this capital structure afresh and finish this. Okay, because we want long class for this. It's all theory, but very dry theory and very conceptual based theory. That's what I'm saying. So Saturday is the deadline for corporate issuer subject, and then we will we will do more of reporting. Okay. Thank you all of you.
Thank you, sir.
Thank you all of you.